relief for car buyers. A July inflation report showing new and used car prices keep falling.
In the first 3 months of 2023, the auto loans industry started showing some of the earliest warning indications of an impending increase in negative equity. Today, experts are worried that a perfect negative equity storm is brewing for many car owners. There is a 17% increase in the number of vehicle sales that feature a trade-in with a negative equity balance. This is just one of the developments giving lenders and automakers a cause for concern. Numerous borrowers could find themselves in extremely precarious financial situations as a result of a rapid and significant increase in negative equity, which would have repercussions throughout the whole financial automobile industry. But what is negative equity, and how can one avoid this? According to a report that was just published by Edmunds, falling automobile prices might put Americans who are now paying high interest rates on their auto loans into a situation where they have negative equity. When it comes to car loans, having negative equity or being underwater means that the amount of money owed on the finance is greater than the value of the vehicle. According to Patrick Rosenberg, Director of Auto Financing at J.D. Power, the risk that customers face is that when they want to acquire a new car, they will need to cover the negative equity with their new loan, or they will have to stay with their current vehicle for longer. Also, the replacement cost, if the car is totaled, may not cover what is owed on the loan. Lenders will incur greater losses on repossessed properties if the property has negative equity. Consumers reaped the benefits of cheap loan rates and increased trade-in values at the beginning of the pandemic, which helped insulate even the more problematic financing decisions from resulting in negative equity. But as we have transitioned over the past few months toward an environment with falling used car values and rising interest rates, consumers have become less insulated from those riskier loan decisions, and we are only seeing the tip of the iceberg when it comes to negative equity. During the first 2 years of ownership, an automobile typically loses roughly 20% of its value. Because of this, there is a possibility that you will end up owing more money than the value of your vehicle by the time you have paid off your loan. For instance, if you still owe $15,000 on your automobile, but it's only worth $10,000, you have a negative equity figure of $5,000. However, you can lessen the impact of your car's depreciation on your finances if you are aware of the value of the vehicle you now own and the amount of money you have lost on it. So, how can a person know if their car has a negative equity? You can get in touch with your lender to learn what the current price of your automobile loan is to determine whether or not your current auto loan has negative equity. After you have that amount, you should do some research to find out how much the model you own is currently worth. There are several websites, such as Kelley Blue Book, that can provide you with information regarding the value of your vehicle. To estimate your car's value, you will need to know specific information about it, including the car's mileage, the year, the make, the model of the automobile, and the state that the car is in. And how does one end up with a car loan that has negative equity? You may still wind up with a negative equity balance, even if you are current with all your monthly payments and make them on schedule. This may occur due to a variety of causes. For example, you may have put a very small amount toward the purchase of your car. When you borrow money to buy a new car, the lender typically requires you to make a down payment first. Your interest rate, total loan duration, and monthly payment amount will all be impacted by the amount of money you put down as a down payment. It will also impact the equity you have built up in your auto loan. Because making a larger down payment typically results in lower monthly payments and improved loan terms, doing so can assist you in avoiding negative equity on your car. You can have a negative equity in your auto loan if you made a small down payment on your previous loan. This could also happen if you have a history of defaulting on loans. The reason for this is that your monthly payments and your interest rate will be increased if you have a habit of defaulting. Another reason your car may have negative equity is that you drive a lot and have many miles on it. When a car has a high number of miles on the odometer, its value decreases. Therefore, if you drive more miles than the typical person does in a year, you may have more negative equity in your vehicle than you initially anticipated. For illustration's sake, let's assume you drive a 2017 Chevrolet Equinox that has been well maintained and accumulated 70,000 kilometers. According to Kelley Blue Book, the vehicle's value that can be traded in will be around $25,000. This price, however, falls to $14,774 if the vehicle is the same year, make and model, but has 150,000 kilometres on it. Therefore, in the first scenario, you would have a positive equity number, even though you still owed $20,000 on the vehicle. However, if you have greater mileage, you will be in a negative equity position with your auto loan. Also, the amount of wear and tear on your vehicle is one of the factors that will determine whether or not you have a positive or negative equity on your loan. When it comes to potential buyers, a used car's value decreases proportionately with the amount of damage it has sustained. Maintaining a high level of upkeep for your vehicle will help you prevent falling into a negative equity position. This includes taking the vehicle in for regular maintenance and maintaining it clean and free of any body damage for as long as possible. You can also wind up with a negative equity position if the terms of your first loan aren't favourable. In today's market, most auto loans are extended for a period of 6, 7 or even 8 years. It's possible that your monthly payment will go down if you take out a loan with a longer duration. Unfortunately, the value of cars continues to fall with each passing year. Therefore, the longer you take to pay off the loan amount, the more likely you will be in negative equity when the vehicle hits the 4th year. Negative equity can cause problems for you if you wish to trade in or sell your vehicle, but there are other challenges that you could face as well. When you owe more on an automobile than it's worth, you risk having problems. This is true even if the vehicle is in fantastic condition, has little mileage, or has other desirable characteristics. If you are in a hurry to sell your car, you may find that you must pay the remaining balance of the loan out of your own personal funds. Also, the interest rate on your upcoming auto loan will be very high. If you have negative equity on your existing car loan and need to take out a new auto loan for your next vehicle, the cost of the new loan can be higher than it otherwise would be. When you trade in your previous vehicle, the dealership you work with can offer to pay the remaining money in one lump sum. This may make it easier for you to acquire your subsequent loan. Nevertheless, the dealer may wind up costing you the total cost of that one-time payment by including it in the overall cost of your subsequent auto loan. You can get a more expensive vehicle by trading in a vehicle that has a negative equity balance, but this may not be the most prudent financial move for you to make. This is because it is highly possible that you will have even greater negative equity or prolong the cycle of negative equity with your new loan. If you are currently behind on your car loan payments and you want to buy a new car, it is possible that you will need to make greater installments or prolong the length of your loan to guarantee that you will be able to afford the monthly payment. That's all from this video. Have you ever been in a situation where you have negative equity on your car or home? I hope you learned something new and enjoyed the video. If you did, please give it a thumbs up and subscribe to our channel for more videos like this. See you in the next one.